I'm Sameer Sheth and I lead the deal advisory practice in BDO India. Nirmala Sitharaman presented the budget for financial year 22-23, which can very well be termed as a pro-investment, pro-growth budget. In next few minutes, we will attempt to provide you the highlights of key budget announcements, including the significant priorities, investment themes, financing, taxation, and what does it mean for economy in general. The V-shaped recovery post the pandemic clearly shows the resilience of Indian economy. Our economy is estimated to have grown at a pace of 9.2% during the financial year 21-22, which is highest among the large nations. The economic survey pegs our growth for FY23 at a similar pace of about 8 to 8.5%. The budget seeks to lay the foundation and give a blueprint to steer the economy over the next 25 years, popularly known as Amrit Kal, the golden period from India at 75 years after independence to India at 100 years after independence in 2047. The budget continues to provide impetus to inclusive growth and lays 4 clear priorities. First priority is PM GatiShakti. PM GatiShakti is a transformative approach for economic growth and sustainable development. The approach is driven by 7 engines, namely roads, railways, airports, ports, mass transportation, waterways, and logistics infrastructure. A master plan is being developed with focus on building world-class modern infrastructure and logistics synergy among different modes of transport, which will help raise productivity and accelerate economic growth and development. Some of the key focus areas of PM GatiShakti for 2023 include expansion of highway network by 25,000 kilometers, and for that, mobilization of INR 200 billion through innovative financing ways to complement public resources. On railways front, railways is tasked with the responsibility to develop new products and efficient logistics services, specifically for small farmers and MSME sector. 400 new generation Vande Bharat trains and 100 GatiShakti cargo terminals for multimodal logistic facilities are expected to be developed over next 3 years. PM GatiShakti is expected to be India's expressway towards the infrastructure development. Second and one of the most important priority is inclusive development. This covers various aspects. Significant emphasis has been placed on agriculture and use of technology in the agriculture, as well as innovative funding models through NABARD. There is a focus on irrigation schemes such as Ken Betwa Link project with a significant cost of 446 billion. MSME forms the backbone of Indian economy. Emergency Credit Line Guarantee Scheme provided much needed credit to 13 million MSMEs last year, and this scheme has been extended by 1 more year, and the guarantee cover has also been increased by additional INR 500 billion. Plus, the Credit Guarantee Trust for Micro and Small Enterprise, along with the rollout of RAMP program, will further help in making MSME sector more resilient, competitive, and efficient. Apart from that, there has been a significant emphasis being placed on skill development and universalization of quality education. Efforts have been made in providing tap water to a number of households in the country. A total outlay of 600 billion rupees has been made to provide tap water to 38 million households in 22-23. Likewise, INR 480 billion has been provided under PM Awas Yojana to provide 8 million houses to eligible beneficiaries. Last but not least, there is a significant emphasis being placed on digital banking and digital payments to ensure that nook and corner of the country is covered under the formal banking channels. Thus, it can be seen that various aspects of the economy are being covered under the inclusive growth. Moving on to priority number 3, production enhancement and investments, sunrise opportunities, energy transition, and climate action. In recent years, over 25,000 compliances were reduced and almost 1,500 union laws were repealed. With this, the country is aiming to move towards ease of business version 2 and also ease of living. This will involve various initiatives such as improvements to single window clearance facility for green projects, e-passports, urban development and mobility, digital land records, spectrum allocation for 5G rollout, and many more. Significant emphasis is also being placed on development of sunrise sectors and climate action. For EV sector, considering the constraint of space in urban areas for setting up charging stations at a scale, a battery swapping policy is being brought out and interoperability standards are being formulated. Further, to facilitate domestic manufacturing for achieving the ambitious goal of 280 gigawatts of installed solar capacity by 2030, an additional allocation of INR 195 billion is being made for production-linked incentive for manufacture of high-efficiency modules. One of the most important highlights of this budget has been the focus on capital investments, and hence financing of investments is the priority number 4. Capital investment holds the key to speedy and sustained economic revival and consolidation through its multiplier effect. The virtuous cycle of investment requires public investment to crowd in private investments. At this stage, private investments seem to require that support to rise to their potential and to the needs of the economy. Accordingly, the outlay for capital expenditure in this union budget is being stepped up sharply by 35% to INR 7,500 billion in 22-23. This has increased more than 2.2 times the total expenditure in 19-20. Government is considering various innovative structures to fund this capex requirements, including issue of green bonds. Government is also looking to set up an expert committee for comprehensive look at P and VC investment regulatory structure, as Ps and VCs jointly invested about INR 5,500 billion just in the last year. Clearly, this budget has laid the emphasis on growth and investment. As a result of pandemic, every economy has been forced to keep the earlier fiscal management targets at the back seat, and same is the situation in India, with estimated fiscal deficit being at 6.4% of the GDP for 22-23. However, given the current times, as the world is just coming out of pandemic, it is very important to lay the focus on capital investments for a continued growth. The budget seems to be taking the country on a right track to achieve the targeted growth of 8 to 8.5% during FY23. I will now hand over to my colleague Pranay Bhatia to walk you through some of the tax and regulatory changes proposed in the budget. Thank you.
Thank you, Samir. Hi, I'm Pranay Bhatia. I'm partner and leader for tax and regulatory services for BDO in India. I'll now quickly walk you through some of the important direct tax related amendments. Let's start with changes which are not made. One thing which is not changed is the tax rate, and which is a very welcome sign from the overall perspective. Tax rates, whether for corporates or for individuals, are not tinkered at all. Moving forward, there are some changes in relation to COVID expenses. The employees who receive reimbursement of medical expenses from their employers are not subjected to tax in their hands. Further, any ex gratia payment which is received from the employer is also not taxed and is fully exempt. However, if an individual receives any reimbursement or any ex gratia from other persons, then there is an exemption to the extent of 10 lakh rupees. Let's now move on to another amendment. There are extension of exemptions which are provided, which is again a welcome move. It was introduced in an earlier budget cycle that if you are a new company which is setting up a manufacturing facility in India, you will be entitled to pay tax only at the rate of 15%. This concessional regime has been extended so long as the manufacturing unit begins manufacturing before 31st March 24. Further extension is also given to those startups who are set up before 31st March 2023. The next amendment is in relation to taxation of capital gains. If there is an investor which has invested into listed equities, the capital gains is taxed at a 10%, but the surcharge could go up to 15%. However, when the long-term capital gains are earned in relation to other assets, the surcharge could go up as high as 37%. To bring parity in relation to these aspects, the FM has introduced a proposal where all long-term capital gains, whether earned in relation to shares or any other asset class, will be capped at 15% surcharge. This is a welcome move because it induces the investors to stay long-term in various asset class. Let's now move to the next amendment, which is in relation to the GIFT City IFSC. GIFT City has been an important project and a number of initiatives have been taken in past to bring it and make it world class. However, there are always areas of improvement, and in this year they have introduced many more exemptions in relation to some of the income streams, royalty, interest, lease income in relation to ships have been specifically made exempt from taxation. There is also a proposal to enable foreign universities to be able to operate from Gift City without any restrictions from a local perspective. Let's move to another one which is in relation to the updation of tax return. Now this is extremely important amendment because it is now giving an opportunity to all the taxpayers to update their tax return within a period of 2 years from the end of the assessment year. Now what does it do is, you never had an opportunity to file an updated return if you missed a deadline which was within the assessment year or the extended deadline. Now this allows you to file an updated return and disclose all your income, pay taxes. Of course it comes at a cost of 25 to 50% of penalty depending upon how quickly you are able to update your tax return. This also gives an opportunity to correct your data and information and sync it with what data government already has. This is the intent. Let's see how it goes forward. Moving forward, the next is in relation to a very important point. Various high courts have been taking a consistent view that cess, when paid in addition to tax, is a business deduction and is not really tax, so as to make it disallowable. In the memorandum explaining the provisions of the budget, government has outlined why cess is akin to tax and therefore not allowable as a deduction. And the government doesn't stop there. What they are saying is they are intending to make a retrospective amendment from 2005 clarifying that the cess is not tax, cess is tax and therefore not allowable as a deduction. The next one is the most important amendment in relation to the virtual digital assets. This asset class has not got any recognition in terms of the regulation, and we are still awaiting regulations. We have heard that the regulation were drafted, they went for redrafting, it never came in winter session, it never came in budget session. But in the current budget session, they have now provided for how the taxation of the virtual digital asset will be done going forward. I would say that the proposed mechanism is prohibitive and it does not encourage investment in the asset class. Be it as it may, let's look at what is the amendment or what is the proposal. The proposal is to tax the entire income arising on this asset class taxable at a special rate of 30%. No deduction to be allowed in relation to this asset class except for the amount that you paid to buy the digital asset. Not only that, if you are dealing in these assets, there is an obligation cast even to do 1% withholding tax depending upon who is the buyer, who is the seller, etc. But that's not enough. There are a number of areas which are left open in relation to this. That's one way to look at it. Another way to look at it, and it's a start for India, how they are going to tax digital assets. Are there going to be relaxations going forward? Are there going to be clarifications going forward? There is also a clear announcement that RBI will come up with its own digital rupee, and therefore what will be the taxation there? These are all the aspects which would get clarified over a period of time as we go forward. These are some of the important amendments which are already proposed. I think it's also important to look at what are the misses which were expected before the budget came in. There are a number of propositions in terms of the international tax developments, be it in relation to OECD's Pillar 2 propositions or India's commitment to US that it will phase out equalization levy. However, there is no indication how this phase out will happen, how India will continue to adhere to its commitment under the OECD and G20 guidelines. That's again a big miss. I think also there is no clarification which is issued whether in relation to work from home expenses, whether employee or individuals will get any benefit. Is there an ability for them to increase the standard deduction? I don't think we have done that. I think we have many more areas to look at in terms of what could have been done. Now I will hand over to my colleague Gunjit Prabhakaran to outline the indirect tax implications and also conclude this analysis. Thank you.
Thank you, Pranay. Moving on to the indirect tax related announcements. The most important announcement in today's budget was with respect to the Special Economic Zones Act. The Special Economic Zone Act and the allied rules will be replaced with a new legislation. The legislation will seek to not only reduce the compliance burden but also ensure enhancement of export competitiveness. Moving on to some of the important goods and services tax related amendments. Most of the amendments were more so towards input tax credit related availment and restrictions. The most onerous one being that way forward assessees will be eligible to take input tax credit only to the extent of the credit getting reflected in the GSTR 2A and 2B. Fairly onerous given that the multitude of input tax credit restrictions which already exist. Another restriction that has come into being, it pertains to if an assessee has not filed their GSTR 1 for a particular return period, they will not be in a position to file the next return, the GSTR 1 return. Again, to ensure that the compliances are being undertaken on time and there are no delays in filing of return or in payment of taxes through GSTR 3B. There have been some welcome amendments with respect to the timelines for availment of credit and issuance of credit notes. Presently, an assessee is eligible to take credit up to 30th September of the following year for a particular financial year. However, way forward, there is an extension, and instead of 30th September, the deadline has been moved to 30th November of the following year. Similarly, credit notes can be issued up to 30th November of the following year, giving more time for the companies to review their data, reconcile the books and the returns, and ensure that there are no losses as far as credits are concerned. Another very welcome amendment is with respect to transfer of unutilized cash balances in the electronic cash ledger from one GSTIN to another GSTIN, meaning thereby if there is some sort of a cash sitting in one GSTIN and there's no consequent output liability to exhaust the same, now the GSTIN under the same PAN can ensure a transfer from one GSTIN to another. Moving on to the customs related announcements, and there are two specific points that I would like to discuss. The first and the foremost is the gradual phasing out of the customs duty exemptions on imported goods, capital goods namely, and the project imports. There are more than 40 plus notifications pertaining to these exemptions which will be gradually phased out, and clearly this is being done to augment domestic manufacturing. Last but not the least, a very significant amendment under customs law. The definition of the term proper officer under customs law has undergone a change. This is more so in line with or in light of a recent ruling of the Supreme Court, where it was held that an officer of Directorate of Revenue Intelligence did not fall within the ambit of the definition of proper officer and did not have the power to issue a show cause notice. There has been a requisite amendment that has been brought about, which would mean that not only an officer of customs preventive but also an officer of Directorate of Revenue Intelligence would be entitled or would have the jurisdiction to issue the show cause notice in identified matters. Not only this, but also the amendment talks about the flexibility that the government has created, that in future if there are matters or if there are cases wherein they can delegate the powers, the customs officers can delegate the powers to different classes of officers that have been created under the amended provision. So overall, a great budget, a budget for growth and inclusive welfare, and definitely a roadmap has been laid for India at 100.